Welcome, everyone. I am Haley Ship with the Ranchers Stewardship Alliance, and we are so glad to have you here as part of the first webinar of our 2024 Rural Resilience Series. This is the fourth year that we've been using this digital platform to bring specific ag education to our community. We're excited about this year's lineup again, and after tonight's session with CattleFax, we'll be talking about adding goats to the operation in February, community resilience in March, and then direct marketing beef in April. And just like we do tonight, we'll send you an email ahead of those events so you can join in if the next topic tickles your fancy. But those will all be the fourth Thursday of each respective month. So as we get going here tonight, we want to do some housekeeping. Go ahead and turn your camera off tonight so the video feeds don't bog down the system. And we'll just have our presenter as well as our RSA staff on screen. Upon entry, your microphone has already been muted, so please pay attention to keep it that way. Towards the end of this webinar, we are going to have a question and answer session, but that'll be run via the text chat feature. So there's no reason to flip that back on. And now that the housekeeping is done, who are we, who am I, and why are we bringing you this webinar tonight? I am Haley Ship. I am the Communications and Outreach Lead with the Ranchers Stewardship Alliance, of which this webinar is a product of. Now, Angel DeVries is joining me as well. She serves as our Executive Director and Tech Support for tonight's call. We are a rancher-founded nonprofit. We were started in 2003, and we are run by a board of volunteer ranchers. Physically, we are located in Malta in north central Montana, and you can learn more about us on our website. Angel's going to be dropping that into the chat there. As we talk about this specific region geographically, we excel in showcasing how responsible ranching is good for rural communities that we live in, as well as for the wildlife habitat that we support, constantly working with non-traditional partners as we provide support, both monetary and otherwise, to ranchers that want to improve their infrastructure. Now, while we geographically have some limits with those projects, our educational branch, which is what we're doing here tonight, knows no bounds. Part of the vision of the Ranchers Stewardship Alliance is believing in a future where ranching and rural communities are so successful in the northern Great Plains that ranch families never need to consider selling or transitioning their land out of production agriculture. We stand wholeheartedly with that mission and believe that, just like any industry, continuing education only adds to that strength. So that is why we're here tonight. Before I introduce our speaker, we're going to dive into 3 pitches from the Ranchers Stewardship Alliance. I'm not asking you for a ton, but just a little bit here tonight. And if you enjoy what you've heard here this evening, I know that each of these won't be hard sales. So first off, the Ranchers Stewardship Alliance does have a YouTube channel, and we're working diligently to get our subscriber number up on that. And in fact, after this presentation tonight, this information will go up on our YouTube channel. If you hop on over to that site and hit subscribe, we would greatly appreciate it. And Angel's dropping that link into the chat there as well. Number 2, we started a podcast, and I know you're saying, who doesn't have a podcast at this point? Ours, we wanted to be just a little bit different from the others that are in this agricultural arena. We partner with myself as the host, and then we bring on a rancher board member, and we ask all sorts of questions from the surface, kind of the superficial questions, which I provide, great for somebody that's just beginning, and then to the much more on-the-ground knowledge type questions that our rancher co-host asks of the guest. So it's called the Ranch Stewards Podcast. You can get it on all major platforms as well as online on our website, and Angel again is adding that link to the chat tonight. And then lastly, we do offer a non-voting membership. Again, the link is in your chat for individuals, couples, or businesses that want to support our cause, as well as business sponsorships for those that want to get a little bit more airtime in what we provide. So we want to thank you to our business sponsors this year. We've got our Big Sky sponsors, which include AgWest Farm Credit, AgriBest Feeds, and Montana Livestock Ag Credit. And the link for being able to, again, become a member if you choose to do so, available in the chat section there. So with no further ado, let's get into tonight's presentation. CattleFax, for folks that aren't aware, I'm sure you are, but we're going to kind of reinforce just how big of a hitter we have as we start out this Rural Resilience series. CattleFax is the global leader in cattle and beef industry research, analysis, and information. Since 1968, the organization's exclusive industry database has set the standard for market information and analysis. Their expertise translates to a more profitable bottom line for beef producers, allied industry business partners, retail and food service establishments, and financial institutions. CattleFax analysts provide information and research designed to meet the unique needs of the cattle and beef industry. Florida native Matthew McQuagge completed his bachelor's degree in animal science at the University of Florida. While at UF, Matthew was a member of the meat animal evaluation, livestock, and horse judging teams. After graduation, he went to work for Cactus Feeders in Southwest Kansas for 2 years. Following this, Matthew moved to Colorado to pursue a master's degree in animal sciences with an emphasis on reproduction at Colorado State University. He is now finishing up a Ph.D. in the Beef Systems Group, still with the Animal Sciences Department at CSU. His research focuses on profitability indicators in Colorado beef cow-calf operations. Matthew joined CattleFax as an analyst in August of 2023, and his primary responsibilities include research and analysis on the cattle markets, with an emphasis on the cow-calf and stocker segments. So, Matthew, I've talked long enough. We'll go ahead and turn it over to Matthew McQuagge of CattleFax.
So here's the roadmap for tonight. We'll start out with corn and hay situation. Then we'll kind of move into the cattle supply and look at some of that outlook from a cycle standpoint. From there, we'll transition into a little bit more of a global effects, looking at the economy and different demand expectations. From there, we'll kind of move into our price forecasts and expectations for 2024. And we're going to try to wrap this up with a calf demo market discussion. At that point, try to make it a little bit more applicable to some of your own operations. And so jumping in, starting out with U.S. corn production and yield. Last year in 2023, we saw record yields and prices for corn, or record yield and overall production, sorry about that. So again, this came on the back of lower harvested acres. So we saw increased yield and tonnage per acres. But this increase in supply was not necessarily offset by an increase in demand. So this led to an overall higher stocks to use. And so as we look at that here, these gray bars here are stocks to use percentages. Again, right now, we're currently at around, or coming into this year, we're expecting around a 15% stocks to use. Again, we saw the last few years, we saw that decreased production, decreased stocks to use, which resulted in higher prices. This past year, though, we've been able to produce a little bit more, and prices have come back down to the relief of many. Again, so as we look forward, look ahead, for this year, we expect prices to average around that $5 to $5.25 bushel. This is about 50 cents, 60 cents lower than what we saw in 2023 with $5.64 average per bushel. Again, here, this shows that stocks to use ratio that I was talking about. We went back to this last chart. You saw during 2020 through 2023, we really decreased that stocks to use ratio, and it resulted in these price shifts going higher. And again, we're seeing that start to come back down with what we would call maybe a little bit more normal stocks to use ratio. Again, that causes us to expect an overall softer tone throughout the year. Looking ahead, we do expect a little bit of a spring rally in price as we start to get a little concerned possibly about expectations on yield on this upcoming crop. But then again, we expect that rally to then soften up and probably reach the limits or test those 2023 lows and start to come back down a little bit. The advantage to this is these lower corn prices result in cheaper cost of gains in the feed yards. And this lends support or is supportive to both cow-calf and feeders prices, as it allows those break-evens to be a little bit narrower or lower, at least from the feeder standpoint. We do have to watch this though, as we see lower corn and soybean prices that while it benefits us, it also benefits competing proteins. So that's something to keep in the back of your mind. Transitioning into our hay production. 2022 was record low tonnage or ending stocks of hay, and that resulted in extremely high prices. 2023, we recovered that a little bit. We produced a little bit more metric tons. We saw prices drop off just a little bit. And we expect that trend to continue into 2024. Right now, we're forecasting an average cost per ton across the United States to be at around that $185 to $190 price. And we will see some substantial regional difference within that, though. I've got a slide here in a minute or two that shows Montana production and prices. But again, looking at this overall, looking at our 2023 values, we're still pretty low when it comes from a stock standpoint. We'll need another year or two of decent or good production to really help bring that price down some. But again, we're all dealing with the same thing, and that is the weather, the lingering drought, especially in some of those southern plain regions, serving as headwinds here. So here we're looking at the correlation between, or the trends between monthly hay prices and corn spot futures. Hang on, give me just a second. I'm moving this tab on my screen. All right, sorry about that. And so as we look at this, you can see corn and hay prices generally trend together. And as we've seen corn prices come down, that shows us that there's a little bit more opportunity for hay prices to relieve their pressures. And so again, we expect to see a little bit more improvement here in the future. And here was some all hay prices over the last few years for the state of Montana. So again, being a little bit further north, you all did not experience that drought impacts quite as much as some of the southern plains regions. And so that led to you all having a little bit more rapid price relief in 2023 than what some of the other regions saw. And so while that has benefited you this past year, that also means that we would not expect quite that $30 cost per ton decrease in 2024 to be as noticeable for you all. We still expect a little bit of a decrease in hay price per ton, but you've already seen a drastic move in your hay prices. And so that'll soften a little bit and be a little bit more stabilized next year from our expectations. Transitioning to the cattle cycle. So the long-term cattle cycle in the United States tends to last about 10 to 12 years from cycle high to cycle high, or cycle low to cycle low. And so as we look at this, we'll see periods of extremely large harvest numbers or slaughter numbers start to taper off and fall off. As that supply decreases, demand increases, and we'll see cattle prices start to move higher. And with a little bit of lag, we'll see cow inventory follow that. And so this overall shape of the cycle is very predictable, but within different cycles, it'll be slightly different from year to year. And so here in a little bit, we'll showcase some of those differences between the different cycles, but I wanted to get everyone kind of thinking along the same lines as we look at this. And so starting 2019 was our last cycle high in terms of inventory numbers. Then we've been in liquidation ever since. And as we look at our current cycle, or as we think about where we're at right now, we expect our rebuilding phase to last a little bit longer and be a little bit more drawn out than what we saw in the last cycle. As we look at this on a long-term chart, what this does is this showcases the efficiencies that we've achieved in the beef cattle industry. So from the 50s into the mid 70s, we saw rapid increases in cattle inventory numbers. And from that point where we peaked, we started to taper off and decline, but beef production continued to increase. This is due to gains in animal husbandry practices, genetic influences on weights, better feeding systems, and coming in more recently is utilization of the dairy industry, particularly with that beef on dairy crosses that we're starting to see more and more across the United States. In 2022, we saw a record beef production with the smallest cattle inventory since the 50s. But then as we think about this and as we start to look ahead, we had a 4.7 million head decline just in the last few years alone. This is due to the impacts of drought and other production headwinds. And so while it's not been as noticeable up in your region, it's been very strong throughout the last few years, particularly through the southern and central plains, up to the North Plains. This drought monitor is from back in October of this past year. So this has been a time point where many producers were thinking about retaining heifers and that decision to move forward and begin to try to expand. But you can just see here that Mother Nature was not supportive of that. You look at the states of Texas, Louisiana, up through Oklahoma, Kansas, Nebraska, Missouri, all of these regions just were really hammered. And these hit a lot of states within that top 10 ranking in terms of number of beef cows. We're looking a little bit better today. This was updated last week. And so again, drought has decreased a little bit, but we're still pretty cautious. As we look ahead, we've been in an El Nino past few months, and that's very supportive in terms of precipitation for cattle producers. But as we start to look ahead, this bottom axis represents months by their first initial. So we have December, January, February. And as we start to move into that early springtime, that El Nino probability starts to decline, and we start to transition into more of a neutral environment. And then as we transition further into that summer timeframe, June, July, August, we see the potential for La Nina to return, move up quite a bit. And so what this tells us is that people who were at this point trying to expand or thinking about expanding, maybe some people in these regions were trying to hold back a few more heifers, they're still going to face some struggles moving into this upcoming year. And so we kind of saw some of that this past season, where people were trying to retain heifers, and it led to more heifers showing up in the supply later than what we typically see. And unfortunately, we expect that to continue a little bit. Here's our beef cow inventory. This is based off of the January beef cattle report. The update for 2024 comes out next week. And so that's something we're really looking out for. And so as we look at this, again, right now, we're at the smallest beef cow herd since 1962. Same time, we're also, or along those same lines, we're seeing the smallest number of ranchers or ranches. In 1962, we had 1.3 million ranches, and today that's down to around 700,000. So vast declines in the overall production side. And so again, as we look at this, again, we peaked in 2019 for the recent cycle in terms of numbers, and then we've been on a steady decline ever since. Again, we saw 3 to 4 million head declines from that 2019 peak into where we're at today. And within this report, we expect another 600,000 head decline in that January report. So at this point, one thing I want to highlight, when we look back at that last cycle, we call it kind of a V bottom, because inventory numbers shot down, dropped very drastically, and then as prices shot way up, inventory followed very closely. So we describe that as being a V bottom. We expect this cattle cycle to be a little bit more smoother, a little bit more drawn out, and we'll call that more of a U-shaped bottom. And I'll tell you why that's beneficial here in a little bit, but that's something I want you to kind of think about as we continue to think about this on a cycle basis. Looking at some of the different regions, the Northwest region wasn't hurt quite as much. There was not as big of a decline from 2019 highs to where we're at today or at 2023 levels. Where we did see those decreases is within those northern plains and southern plains, and then a little bit into the southeast and Midwest region. And so those are the areas that are continuing to that we're continuing to keep an eye on, and where expansion has the greatest opportunity to take place when Mother Nature allows. This kind of further supports that. As we look at this USDA beef cow slaughter rates, we did see reduced slaughter in 2023 compared to 2022. That being said, we still have a large amounts on a percentage basis, so we still consider it to be a net culling year. And as we look at this bottom chart, coming in here, we saw a slightly lower beef cow culling rates, but we're still well above that average or that marker of around 9 to 10%, where we kind of draw that cutoff line to where it's culling years versus non-culling or maintenance years. And so as we look forward to 2024, again, it's a little bit lower than what we had the last few years. And so we'll maybe call that a little bit more of maybe that maintenance levels. We're not excessively culling, but we're not rebuilding either. Then as we move into 2025 and 2026, we'll start to see less culling, and that's when we hope to start to call it a little bit more of an expansion timeframe. And so as we look at 2024, we still expect to see a 700,000 drop in terms of that overall culling amounts. And then as we move ahead, transitioning from cow slaughter to steer and heifer slaughter, you look at this, I want to point out that between that 2019 and 2022 level or time, steer and heifer slaughter was pretty level. And then it actually got a little bit higher in 2022. But then in 2023, we expect around, and we're still tying up these numbers, but we expect it to come in at around 1 million head decline. And so that's extremely significant. And then as we look ahead to 2024 and 2025, that's pretty close to another 200 million head declines in terms of available slaughter. As we look at this current year, 2024, again, that's an 800,000 head decline in expected slaughter. Most of that will come in the second half of the year. Slaughter in that first half of this year should be pretty steady, should be well supported, because we had a lot of placements towards the end of last year, and then also current cost of gains are suggesting or encouraging feedlot operators to feed cattle longer than they normally would, and it's paying off to add more weight. But as we look ahead, that the second half of this year is going to be pretty tight. This relates back to that. So this is our January 1st U.S. cattle, feeder cattle and calf supply, outside supply that's not already committed to feedlots. And so this will be something else that we're really looking for on that inventory report that comes out next Wednesday. But as we look at 2023, again, we expect to see decreased slaughter, even though I don't have the chart on here, but January 1st cattle on feed numbers for this year came in above last year's values. That's because we had reduced fourth quarter kills last year or in 2023 as the packers cut their kill levels a little bit. Margins weren't quite there for them, so they cut that a little bit. So that led to a little bit more cattle on feed. And then towards the end of last year, we also imported large amounts of Mexican feeder cattle. The drought in Mexico is really hammering them, and so they shifted a large amount of their supply into the United States. And so that led to some aggressive fourth quarter placements within a lot of these feedlots. And so that'll kind of help carry them a little bit through the first half of the year. But again, we're really going to see that struggle in the second half of the year as they as feedlots are fighting for a very limited supply of available feed or available feeder cattle. As we break that out, we look at replacement heifers. Again, as we look at where we're at, in 2023 and 2024, they're just not there. As I mentioned earlier, we saw a lot of people trying to hold heifers back towards the end of last year, but ultimately the weather wasn't allowing them to do it. And so that kind of drew out or prolonged those heifers entering the feeder supply. But again, not by very much. As we look into this year and then into next year, so these 2025 numbers will be from decisions made in 2024. We expect a small or modest increase because we do expect a little bit of regional expansion in this year, but again, not very much until the following year. So again, this is all tied to our U.S. calf crop. Again, we're coming into this year with tighter numbers. And again, that's from decisions that were made a year or two previously. As we look at this small calf crop, that is going to be beneficial to cow-calf producers as it shifts that market leverage. It's going to shift that leverage more into the hands of cow-calf producers and allow them to command a little bit higher prices. As again, feedlots are forced to compete for a dwindling feeder cattle supply. Looking into 2025, we'll expect a little bit of stabilization there from heifers that are kept back into 2023 and 2024. Because again, it's 18 to 24 months from the time a heifer is born before they can enter the feeders or enter the harvest supply. And so again, we'll kind of see that. And here I want to also highlight again, more of that U-shaped bottom. So as we talk about leverage, this is a great chart to show where we've been over the last 20 years. And so if you look back into the early 2000s, we had excess supplies above what the red line shows was our effective kill capacity. So again, this red line is weekly average fed slaughter capacity. And so over those time frames, because again, we had more cattle than capacity, that caused reduced margins in some of these plants. And so we saw Tyson close several different plants. We saw Cargill close a plant, National, Tyson again throughout these years. And what that did is it led to this point where all of a sudden that leverage shifted into the hands of those feeders, or into the hands of the packers. So if you look at this, all of a sudden we had a much larger supply of cattle that needed to be harvested beyond what these blue bars showed as available packing capacity. Then as we experienced COVID disruptions through these yellow bars, that was top of these lines indicate capacity that the packers had, but that they weren't able to effectively utilize due to some of those labor and COVID challenges. And so that caused this fed slaughter amounts or quantity to increase again. And as we look at this current year, 2023, they kind of evened out. Weekly slaughter capacity was around that 500,000 head mark on a 40-hour work week. And that's about where average fed slaughter supplies were at as well. And so as we look ahead, leverage is really going to shift into the producer's side, as we will have way more packing capacity, way more hooks available than this red line indicates of available slaughter or available cattle to be slaughtered. And so as we look at this moving forward, again, that means that plants will be competing for a dwindling supply. And then I also kind of wanted to highlight this right here. In addition to this decreasing supply of fed cattle, we're looking at some potential increases as more packing plants come online after having to deal with a shortage back here. And so that'll be something to watch carefully over the next few years. And as expansion starts to occur, we're pretty confident right now that packing capacity will be there to meet that demand. So here I have the cattle cycle broken out into the different years. And so this top left chart shows that 75 to early 80s cycle. And these charts, I should add, are all measured from peak to peak in the beef cow herd and inventory numbers. And so we've got here from late 70s, here from the 80s into the early 90s, down here 90s to 2006, and then this last cycle that we all remember so well from 2006 through 2019 highs. And so as we look at this last cycle here, this 2006 through 2019 cycle was not like the others. If you look at these other ones, these other three charts are all a little bit more similar in that they had a more steady, slower decline in inventory numbers, coupled with steadier, slower supply decreases, which then led to a little bit slower price increases. So we look at this this most recent cycle, supply shot down very rapidly, causing prices to then shoot up and then peak before then dropping off again. And so while this resulted in a very good couple of years for cattle producers, the lingering effects weren't as beneficial. And so as we look at this year, we again expect to kind of follow some of these other trends of a little bit slower drawn out, and that should be more beneficial to us in the long run. Looking at these, something I want to point out is that as we see the cow herds reach their low point, in 3 out of 4 of these charts, the high prices came when the cow herd reached their low. And so that tells us that as we haven't reached our cow herd low yet, it tells us that our highest prices are still ahead of us. That being said, once we hit that cow herd low and we start to expand, we understand or we expect prices to start to decrease. And so again, right now, as we're still optimistic on the price side, this will be something to think about in a year or 2 or 3 as prices start to decrease. And you'll want to consider maybe a little bit more aggressive risk management strategies. Something to look at down here. Again, our supply low on all of these was a year or 2 behind when the cow herd low occurred. And again, remember, this is our fed slaughtered low, and that makes sense. Again, as we said, it takes 18 to 24 months from the time an animal is born to when that animal can be harvested. And so that resulted in those lower supplies further on down the road. So as we look at this current cycle, this is our expectations. Again, a slower expansion means supplies and prices are not as abrupt. They're not as directional. They'll be drawn out a little bit more. So ours follows the similar patterns as the previous charts, where the supply low will follow the cow herd low. And we actually expect, since this will be a little bit slower and more drawn out, we expect the price high to follow or come in the following year after the cow herd low and better match with that supply low. And so as we look at this, these are our expectations. We're not guaranteed in this, but we feel pretty confident in these trends or in this pattern movement. One thing I'm going to kind of preach as we go through this is that we've seen some drastic moves, especially this past year, and we expect the next year or 2 to be a little bit more modest in terms of their shifts, whether it comes to inventory or supplies or prices. So as we transition a little bit from that supply to more of the demand side of things and a little bit of the global or the macroeconomic factors, we think that this is important to kind of understand some of these expansion headwinds or supporters moving into the future. So looking at this chart, we'll start with CPI, that consumer price index, and how it relates to inflation. So as we look at this, that consumer price index peaked in 2022. It peaked in 2022. It reached a 40-year high, But then this past year, interest rates or inflation rates fell by nearly half. We ended the year at around 3.5% consumer price index growth from the previous 12 months. And to kind of combat this, the Federal Reserve raised interest rates 4 times throughout 2023, and they ended the year with the prime interest rate at around 8.5%. At this point, we do not expect to see any more interest rate hikes. In fact, the Fed has indicated that they expect to have 2 to 3, around 3 rate cuts this upcoming year. And so as we consider all this, we have to recognize that this rising consumer price index, this high value here, these high interest rates have put a squeeze on the consumer. This inflationary effect has been real. And so we have to think about that as it applies to the consumption of goods and services and how that looks moving forward. And so while we do have to be aware or recognize those limitations it places on producers, we do have to also respect or recognize that historically higher trending inflation rates are supportive to higher retail beef prices. And so that then leads to further or more dollars that trickle down that line. Coming to our unemployment rate, it peaked during the COVID years, and so it's come back down quite impressively, actually. The labor market has remained very strong, very robust, and we expect it to kind of stay about the same moving forward into 2024. We do expect slight, modest increases, but we don't anticipate getting much above 4.5%. And so a strong unemployment rate is supportive to the beef industry as it creates that, or it enables producers or consumers to be able to afford more beef. And we can kind of relate this back to the previous cycles. During those when unemployment peaked, we saw declines in beef demand. And so again, a strong employment rates within the United States is supportive to us. This chart shows that pretty well. As consumer income increases, so does the buying power. But we do have to compare that against inflation rates. And so after the influx of the monies into the economy during the COVID era, we saw a big upswing in inflation rates, and real disposable income has kind of leveled off these past year or so. We do anticipate a little bit more wage growth in 2024, but we don't foresee the consumer necessarily gaining ground as it compares to the inflation rate. And so we do have to recognize that and keep that in the back of our minds as we evaluate demand. So one of the ways we look at that is by considering the USDA all fresh beef retail prices. They've moved higher over the last year or so, but then we did see the last 2 months, first consecutive decline in prices, retail cut prices. But as we compare this to our competitors, pork industry and chicken industry, since 2000, look at how much our price has increased over that same time period relative to these other groups. I mean, we've shot up 200%. While pork is only 100% and broiler is only 60%. And so that says that we're doing something right. And as we think about these higher retail prices, they are supportive, or they trend backwards to support higher cattle prices. Looking forward, as beef supplies are expected to be a little bit smaller, we do see some price limitations or having to manage the available supply through improving price, but we have to be careful not to push out the consumer by raising prices too much. So as we look at that in terms of leverage, over the last couple of years, this is the increase in 550-pound steer calves relative to that all fresh retail beef price. And so as we look at 2023 in this red line, we saw 550-pound steer calves increase in their price relative to that retail beef. And we expect that to improve a little bit more in 2024, but then kind of level off. We don't anticipate it getting much above 40% unless retail prices drop significantly, because at the end of the day, we don't expect steer calf prices to decrease significantly in this upcoming year. And so this leverage ratio is why it's important that we see higher beef prices at the retail case. One of the reasons we've been able to do that is this improvement in the prime and choice grading percentage over the years. This past few years, we've leveled off at around that 80 to 83% of prime and upper 2/3 choice as a percentage of fed slaughter. Excuse me, this isn't upper 2/3, this is all choice. But these high rates, the consumers have indicated that they love that quality and consistency of that. And so that's supportive. That's why we're able to see these increasing prices over the years. As we relate that back to the wholesale level, and so again, this is our as it leaves the packing plants. This is relative to our composite cutout price. History is a strong indicator that as supplies decline, prices will increase. And so as we look at the composite cutout price increase forecasted for the next few years, we do expect that to serve as a bit of a limitation and result in reduced demand. The shift in leverage that we expect to see between the packer and the wholesale beef buyer shifts or supports that the composite cutout will be able to continue to move higher. As we look at it for 2024, we expect that composite cutout to average at around $300 on a per hundredweight basis, with a slightly more modest increase in 2025. And so as we consider that overall supply effects, we need to also look at beef imports and exports. You'll look back in this past year, 2023, the trade balance definitely favored imports over exports. We hit our record numbers in 2022 in terms of export tonnage and prices. We've been on a little bit of a decline since then. Keep in mind, there is a huge cyclical effect in here that's been present throughout the last 20, 30 years. And so while this can be a bit of a struggle for us to consider, we have to recognize the role the cycle plays in this. Some of our challenge to exports, why we've seen decreases and we expect further decreases next year, has been a little bit of struggles in more of the Asian markets. So as you look at this, 2023, we saw declines in our top three exporters. So that'd be Japan, South Korea, and China. Some of those Asian markets are facing both social and economic challenges that we expect to continue into this next year. Part of it is quite simply just their aging population, which results in them consuming less beef. We do expect this to stabilize a little bit. We do expect this to stabilize a little bit in the next year. We won't see as drastic of decreases in exports. And this improvement in imports will mostly come from Australia and New Zealand, and primarily be in the form of that 90% lean beef that we use for grind. So as we consider that, we consider our production, we add in our import total, we subtract our exports and divide that by the US population. That gives us our per capita net beef consumption. As we're tying up numbers, looking back at 2023, we do expect a decrease in per capita net beef consumption. But again, that's just due to a lack of available supplies. We do expect that to continue moving forward by about 1.5 pounds to 2 pounds per person per year. And let me add, so that will contribute to a little bit of that price rationing that we expect at the retail case level. So as we jump into our price outlooks, I wanted to break this out into the 2014 cycle high here, and then again at our 2019 cycle high here. Well, 2020 cycle low actually. As we consider this on a difference between the first half average and the second half average for each year. And then as we relate that to this upcoming year, this supports what I said, where we will see significantly smaller available supplies in the second half of the year that will contribute to that high or that improvement in price for that second half. Packer margins have narrowed quite a bit in 2020 or 2022 and 2023, but at this point they continue to remain just above that positive mark. And we expect that to continue slightly into 2024, but at a much smaller level, and they will be much more subject to these seasonal trends, seasonal swings. As we relate that fed steer price back just on a longer term basis, again, we saw extremely large moves over the past couple of years. This past year, we saw about a $33 improvement just in price per hundredweight on the fed steer basis. We expect that to increase again into 2024, but a much smaller level. Instead of that $33 increase, we'll expect around a $5 to $10 improvement. And so, again, this kind of shows some of that leverage that I was talking about earlier, just on a different relationship basis. So here we relate to fed cattle prices as a percent of the composite beef cutout. And so around that 57% where we expect it to kind of hang out over the next couple of years is the leverage ratio that gives more leverage to the feeder relative to the packer and should result in higher prices. As you look down here again, this is when the packer had all the control, they had all the leverage. And so I show this to highlight how far we've transitioned just in the last 2 years. So as we take that back a step and move from the fed steer to the feeder cattle index, seasonal patterns, they typically start out pretty flat through the early part of the year before moving higher into that early spring or early summer time period. This flatness is due to the large supply of cattle on winter graze out that are coming off and available to enter the feed yards. This year, again, as I mentioned, we're starting out with ample quantity in the feed yards and reduced cattle supply outside. And so we expect that to maybe shift this increase in the feeder cattle price to maybe start to improve in early April instead of a little bit more of that May and June timeframe. Another thing to think about, cattle placed during this time frame are competing or going against the December live cattle contract, which is historically at a premium. And so that's further supportive to this price trend or this price movement. So as we look at this first part of the year, particularly for those stocker operators, we expect prices to have limited downside risk, maybe to 220 before moving higher and advancing and hitting that 260 mark or better in the second half of the year. On the whole, or on the average, we expect around 240 price per hundredweight. And then as we take that a step further back, we'll look at the 550-pound steer calves. So I want to quickly highlight the 2023 year. It did not follow the seasonal pattern very well. As we think about that, we had a rough winter last year. A lot of the graze out in the north was covered by snow, and then we were dealing with drought in the south. And so that kind of limited that upside potential early in the year. That being said, the tighter supplies did eventually push those prices higher. But this year, we're starting out significantly higher than what we did last year. So again, as we look at that, this year, tighter supplies will, as with everything, continue to drive those prices higher. As we look into that early spring, that 315 to 330 is a good window for that March-April timeframe. And then we expect prices to kind of level out, maybe drop off just a little bit, before a more modest decline than what typically happens into that fall run. So on the year, we anticipate an average of $290 per hundredweight, which is an improvement of $30 compared to last year. So this chart shows that change from the second half high or second half low of the previous year's prices to the first half high of the current year's price. And so as we look back at this, the 20-year, the 10-year average, those lines are around that 20-25% improvement from the previous half lows to the first half highs. So if we applied those averages to this year, that would tell us a price of around $335 to $340. We expect that's a little bit too optimistic. And this year we expect to see rates at around that 15 to 20% movement, which again puts us into that 330 range. Moving into our cull cow values. Again, prices are low early in the year as there's a large quantity or a large supply of cull cows. But then as that supply starts to diminish, that drives prices higher and into that early spring and summer. Another benefit to this, or another factor that plays a role, is through the summer time frame or spring and summer is when grilling demand starts to pick up. And so that will really favor that ground beef production, those prices, which then trend back to our cull cow values. This year, we expect a strong seasonal pattern. That our March, April targets are around that 115 to 120 price before plateauing at around 130 per hundredweight through the summer. As I mentioned, that price is heavily correlated with the 90% lean beef production or lean beef values. So as we look back at the last few years, prices have trended a little bit higher over time. We expect that to continue, again, moving higher into the spring and plateauing through the summer. And as we see these higher prices, that again translates back to the higher cull cow values. So one of the things we like to look at is different markets that trend together. Over time, as we compare bred cow values to 550-pound steer calves on a per head basis, those two markets tend to track pretty close. You can see that from the 80s into 2000s, they track very closely. And then the last 10 years or so, that spread has widened out a little bit. This gap has widened as interest rates stabilized, but then has narrowed a little bit this past year as those interest rates shot up and we dealt with those inflation factors, which particularly play a role in those bred cow values. If we remember, bred cows are fixed assets in the herd, and so that's why those interest rates play a little bit more of a role in driving that. And so as we look at these price ranges and look at this price rally, the increase in calf prices have outpaced the increase in bred female values over the past year or two. Again, that's due to some of those expansion headwinds we're facing, the drought, interest rates, labor challenges. But even at these incredibly high cow values, we still think that they're actually a relatively good deal when compared back to the 550-pound steer calves. I have a chart here in a little while that'll kind of show more of that because I know a lot of you are thinking I'm crazy at current bred cow values or expected bred cow values of 2,600. I think I'm crazy for calling that a relatively good deal. But as we look at this, we think about that 2023 period or that time frame, we saw record prices across all classes of livestock and beef, from the composite cutout to the fed steers, feeder steers, and calves. We saw record prices in all classes except for the cull cows, except for the bred cows. If you look back at that 2015 time period, that's when bred cows hit their peak. We have not seen the peak in that yet. So as we expect those prices to move up, that's something you'll have to think about on your own operations as if it pencils out in the long run. We can also compare bred cows back to the fed steer values, again, on a per head basis, and those also track very well. And again, we expect fed steers to continue to improve, so are expectations for bred cow values. And so at this point, it's kind of transitioning a little bit from more of the market outlook to some of our observations or results we found as it relates to cow-calf producers. A lot of stuff we looked at just there is items that you all as producers have very little control over. And so as we look into this next section, it's meant to be a little bit more targeted to decisions you can take home and make on your own operations. And so this first set of results that I'm showing you is data that we collect in our annual cow-calf survey. And so this allows us to track differences between low return and high return producers, as well as track trends over time. So looking at this over the past 3 years, we've seen a 1 to 2% difference between those average and high return producers, and again, between the low return and average, resulting in a overall 4% difference in terms of calf crop between that low return and high return producer. And so in our cow-calf survey, over the last few years, we've averaged at around 375 head operation sizes who are taking the survey. And so if you think about that 4% difference, that accounts to 14 more calves to hit the market. And so it's a pretty substantial difference. Further results from that survey, looking at weaned calf crop percentage by calving season length, you'll see that looking at the differences between that 0 to 45 days and that 45 to 60 day calving ranges, and then 61 plus days across years. And then as we consider that to our weaning weights, again, look at this difference in weaning weights between that 0 and 45 day mark versus that 61 to 90 day, and how that translates to around like a 30-pound difference between groups. Again, as we think about this, that's a pretty substantial difference in overall weight that's hitting the market when we continue to sell our calves on a per pound basis. And so as you look at your own operations, any opportunities that you have to maybe tighten up your calving window a little bit, have more females bred in that first couple of estrus cycles are create some significant opportunities for improvement. And so as we oftentimes look at our high return and low return producers, one of the things we'll notice is a strong correlation between bull purchase price and calf value. And so this chart's always a little bit confusing to look at first. And so the charts or the lines here represent average calf value, and the different colors are what producers paid for their bulls. And so over the last few years, you can see that producers who paid $5,000 or more for their bulls saw an average of $50 per calf increase or improvement. And so if we think about that, that's on a 3-year average, you see a $75 per head improvement. That's across 75 calves. That tells us that we can, or that line for us is around that 5,600 mark for what is reasonable to pay for a bull and expect improved calf values. And so this is further results from some of that. Again, we've got average cow-calf profit across time on a per head basis. And then we separate that out between our high return producers in this green line and our low return producers in that red line. And so again, some of those differences lay particularly as it relates to genetics, nutrition, and animal health. We've got some more charts from this survey data that I'm happy to send to anyone who wants. But we've got, and that really tie into some of this animal health and nutrition stuff. But we've got another way of looking at it through video auction results. And so we collect data from several different video auction services, and we've been tracking it for the past 5, 6, 7 years. And so that allows us to glean some cool characteristics or glean some cool data points that match up pretty well with that survey data. But just for differences in data sources, I want to show it here instead of as it's relative to that calf survey. But as we look back at this, at summer video auction averages, and these are steers 500 to 600 pounds during summer sales for fall delivery. If we look at 2023 video auctions, they averaged an additional $90 per hundredweight above the previous year. As we look at this black line in 2023 and compare that to 2022 and even further from 2021, the video auctions paid off very well this last year. Now, obviously, calf prices improved from the previous year, no matter how you marketed your calves. And so that's maybe not the best comparison. And so here we have that video sales as it relates to cash prices from sale barn auctions. And so as we look at this, over the last 10 years, there's been an average of $75 per head premium to cattle that were sold via video auction versus cash prices, or via that cash sale. And so as we look at this, something I wanted to point out on this top chart, this is northern states, so that includes you all, the Dakotas, Wyoming, and Idaho. And so again, we saw an additional $450 per head above the previous year's values. And comparing that to the cash sales, it followed that trend of $75 per head and actually was just a little bit higher. And so again, we saw the cash sales average at around like 1525, 1540. Whereas those video sale auctions were over $100 above that. And so again, big improvement there. Again, some of that seasonality effects within the cash market playing a role. And then part of that's also there's more added features or added buttons on those video calves. And here's some examples of that. And so this was regression analysis of this past season's video auction cattle. And so as we looked at this, we broke out all the different factors as it relates to these animals. And we compared that to what we would call more of a base animal. And so this is really useful to kind of highlight some of those differences. And so first off, in 2023, uneven weight and horned cattle saw discounts of around that $200 to $250 mark. And so those red and blue lines are that 2023 year. And then we compared it to the 5-year average within these video auctions. One of the biggest long run trends we've seen is that cattle that are weaned for 45 days or more offer significant premiums to cattle that are not weaned or weaned less than 45 days. This past year, that came up to about $10 per head or $10 per hundredweight. And then over time, that's been around that $8 mark. And so on a per head basis, that adds up to quite a bit just from weaning your calves. Comparing different genetic groups, verified Angus, verified red Angus, both saw premiums compared to what we would consider our typical English type cattle. And then I don't have it on here, but continental based cattle or Brahman type cattle and other breeds also saw discounts relative to that base English type calf. So we look at programs. There's a lot of different options here. As we look at this, actually, let me jump to the next slide that shows that a little bit better. Here are some different price differences between different program calves and calves that were non-program or non-program eligible. And so our $0 mark on this top chart is right here. And so as we look at this, we saw substantial premiums on a per hundredweight basis for calves enrolled in like that VAC 45, VAC 45 plus, VAC 60, and VAC Precon programs. Just as a reminder, again, these are all programs that require weaning for more 45 days or more. And so again, that correlates back with what we saw in this previous chart with that weaning premium. And as we look at this, we'll see that VAC 34 and VAC 34 plus didn't see substantial premiums. I mean, there was a little bit across time. It averaged around $2 per hundredweight. But then as we look at VAC 24 down here, across time, it's always been negative. It's always been at a discount. And so this is likely maybe not a discount for claiming that, but there is little advantage in claiming this. And those cattle that are enrolled in this program maybe has some other defects that kind of help drive down their prices. As we look down at this, or as we look down at these other program options, that are non-vaccinated based or non-vaccination type programs. As we look at these, there are a lot of options here for producers to choose, and something to think about if you look at these and say, hey, well, the premiums here look pretty good. I want to consider this for my next calf crop. Some of them require a lot of planning and specific management. Maybe it's with selling at certain locations or having to invite auditors onto your place. And so as a caution, I want to point out that there are some added costs with these. But as we look at these, GAP, which is an animal welfare-based program, it's this red line here, had the largest premium across the last 5 years. The past 2 years, non-hormone treated cattle did pass that. But again, over the last 5 years, that's been about a $3 premium per hundredweight. Moving on down, our green line is verified natural. And again, that offered a slight premium across time, particularly the last 3 years. And as we look at some of these other programs, so natural, natural plus, and source and age verified, all of those had discounts associated with them over the last few years. And so, again, this is compared to the base price. And so as producers enroll in these programs, they're forced to kind of find other options or other ways in which they can offset the discount of this specific program. And so as we look at these again, each program has different advantages or disadvantages if you're considering any of them. Oftentimes, or almost every time, there's increased costs associated with them, whether it's in drugs or labor, feed. If you're weaning your calves and holding them for a while, there's added potential for death loss there, as well as interest expenses. So stuff to think about if you're considering some of these weaning type programs. And then finally, you just have to ensure that if you're going to the effort to enroll in one of these programs and put the effort into this, make sure you also find a marketing strategy that suits or supports these higher prices. And so coming back, I told you earlier that bred cows and bred heifers have increased in prices, but are still relatively inexpensive as it compares to 550-pound steer calves. And so as we look at this, we create a calculator at the end of last year that basically takes into the account the female's purchase cost, puts in her yearly carry cost, and then factors in the forecast values for calf value. And it does that across however many years until she breaks even or pays for herself. And so as you look at this in 2023, with the current female values and where calves are expected to go into the future, it took 2.5 calves for that female to pay for herself. Now, as we look at this, I do want to point out that this is a cash carry cost. And so it does not include those non-cash expenses such as depreciation, interest, unpaid labor, things like that. But on the flip side, it also does not include the salvage value of females. So we kind of put that in there to kind of maybe offset each other a little bit. But this isn't a strategy that you should take onto your own operations and utilize with your own cash carry costs to see if it pencils out. But as we look across time, The long-term average is 4.5 calves for a female to pay for herself or to break even. And so right now, that 2.5, 3.5 calves that's expected over the next 2 years is below that long-term average. That's why I say even at these high prices, females are a good deal. I want to point out this last cycle that we were in 2015. I think most of us know producers that got caught by buying females that were so expensive that with the drop off in calf value in the next few years, those females never paid for themselves. Those producers were upside down there. And so again, that's something to keep in mind and be cautious of as we do start to turn the corner in the coming years and transition higher. So this chart or this table kind of shows some of that math. Again, with this year, we're forecasted at $290 on average for 550-pound steers. That fits in line with that 2,600 bred female forecast. But again, the struggle with this is you have to have not just good estimates of where calves are today, but where they'll be at in 4, 5, 6 years. But this chart shows us that with that $300 estimate for the next few years, or that $300 average that we're expecting, it's not unreasonable to expect to pay $2,500, $3,000, or even more for cows or bred females, depending on how many heifers you can get out of her, or how many calves you can get out of her. Sorry, I know I'm running short on time. I'll speed through these last few slides. So another thing we want to kind of point out is the seasonality of this cull cow market. So this is on a market year basis because it tracks a little bit better with when producers are making their decisions based upon weaning, especially in your region, your neck of the woods, where it's all spring calvers that then wean and cull in the fall. And so as we move into this time frame, there's a significant drop that occurs year after year. And so I wanted to point out the differences between the August highs and November lows. Across the last 20 years, that's been around $100 per head discount or decrease, again, from that August high to November low. And so there's some options here. Maybe if you can, or some options to better manage that, maybe capture higher returns for some of your females. Again, these are things I know you all have heard before, but it sometimes helps to just put fresh numbers on those or new prices. And so as we look at this, so first option is just culling early, trying to get ahead of that slump, trying to get ahead of that decrease. And particularly if you have any like older females that you know are open or you know you're not going to keep around, those might be options to maybe wean that calf early and cull early. And so again, here's that difference between August, September, and 60 days later in October, November. This is a little price model we put together that captures both the cost savings from carrying that female for 60 days in those yellow boxes, along with that difference in salvage value or those cull cow prices that's showcased here. And so over the last 20 years, this suggests an average of $108 per head improvement if you're able to cull that female early and get her out 60 days earlier. The second option is to, instead of trying to sell here, is holding on to her and trying to sell back here. And so another price model we put together showcased or found that over the last 20 years, the market averaged $180 per head average or improvement in value. And so what this tells us is that if you can add weight for less than $1.80 per pound of gain, then you will be on average profitable, assuming you can take that female, feed her for 100 days and add 100 pounds. And so again, this price model includes that carrying cost, that cost for labor, vet, interest expenses, a little bit of death loss in there. But again, this was found to be a profitable strategy 15 out of the last 20 years. So 75% of the time it paid off. And that 25% of the time is closer to break even. And so again, just a couple of options to think about as we work through this. And again, maybe different options work for different years. Obviously, available resources and forage plays a huge role in your decisions, but I just kind of wanted to quickly showcase those. And sorry, I kind of rushed through them, but I want to show them off as different options that you can maybe take home and think about for this upcoming year. So in conclusion, we're seeing supply declines in place that are driving increases in prices overall. This past year in 2023, we saw big adjustments in the markets. We expect that to kind of level out and more modest improvements in the future. But as we think about all this, we expect heifer retention kind of start in late 2025 and into 2026. And as we see, or as we look at these improvements in prices and that decrease or that improvement, especially as it relates to leverage over cattle feeders and packers, we really expect to see steady to higher prices for the cow, calf, and stocker operators. As we think about this, we do have to remember that consumer demand will be the key to limit or key to seeing how high this market can go. And then another maybe disadvantage, or maybe not disadvantage, but factor we have to consider is that prices improve, so too does the cost of interest expense or the cost of money. And so I think someone had mentioned that early on as one of their concerns moving forward. And so again, that the amount of capital necessary will become even greater within these higher values. And so in conclusion, this is everyone's favorite slide. Cow calf producers are expected to gain further leverage into the coming year. We expect to see cash profits on a per head basis at around that $500 per head mark for cow calf producers. But ultimately, this all results in more dollars per head in the system. And that trickles back to the beef cow calf producers and creates ultimately a more sustainable system. So that's beneficial for everyone. And this is the result of improvements in our beef cattle industry. We have a lot to be proud of here, and things are looking ahead for the future. So in conclusion, we're still in liquidation, tighter supplies next few years. Drought alleviation is expected for short term, but long term transition back to that La Nina. So again, that's why we're pushing those supplies back into 2025 and 2026. Prices will move higher, but the higher prices mean more equity at risk. And so as you consider this, especially the equity at risk, be sure to consider your different risk management options, whether that's LRP or other options in futures or other strategies, to just make sure you don't get caught. At the end. So in conclusion, I just want to quickly point out, we'll be at the NCBA convention. If any of you all will be there, please stop by our booth and say hello to us. We have a larger, more elongated market outlook than what I presented today. And then also I showed a little bit of that survey data. If you have a chance to take this year's survey, you can do so through our website. And that helps us just be more accurate with next year's results that we can then turn around and present to producers. So I'm sorry I went over time there, but it takes a little bit of time for questions if anyone has any.
Absolutely, Matthew. So what we do with our questions here is that we do it through the chat. And so Angel's getting us switched over to where we've got both Matthew and I on the screen. And if anybody has a question tonight of Matthew, go ahead and type it into the chat, and then we'll get some of those questions asked. And so Matthew, first off, thank you. That's, I always say I'm very grateful for people that can do these jobs that I just cannot do. And I love getting the numbers and being able to digest them, but you all are above and beyond with figuring out not only what the numbers show, but anticipating what the questions and what the producer need is going to be from those. So we've got one question here. How do the droughts in both Mexico and Canada affect your outlook?
Great question. Yeah, so they played a very large role this past year, especially in that cattle on feed numbers, and they are beneficial to us in providing a little bit more of that supply and whatnot. As we look ahead to this coming year, I didn't show it on our charts, but we're predicting more drought conditions for the second half or later end of this year. Mexico is forecasted to really be hammered next year. And so that's going to cause, first off, more liquidation in terms of their cow herd, but that will also result in more supplies coming into our country and helping fill some of that empty space within the feed yard. And so as it relates to calf prices, it's maybe a little bit bearish to calf prices, but but with where supplies are at, it's not a huge concern for us. And it'll be perhaps a little bit more beneficial to those further markets, like the feedlots and the packers.
And so adding on to that, she says, does it then create a shortage in a few years?
Yes, yeah, we are. Yeah, we're going to continue to see supplies decline, and that's going to display itself at the retail case level, where we'll have to do some price rationing. We'll see those improvement in prices to kind of deal with some of that limited beef. On the flip side, we're going to continue to increase our imports. Australia and New Zealand are both in good spots where they can continue that. And we'll continue to get some from Canada and New Mexico, but they're a little bit closer to us in terms of weather outlooks. And so they'll be going through some of the same stuff we will. But yeah, the supplies will continue to move lower over the next few years.
Well, you answered David's question in that answer. So that was perfect, Matt. As we look at some of what you presented, I know one of the things that popped up for me is just the difference in how you market a calf and what programs you might be under. You emphasized that the video sales, according to the data, seem to be showing a premium. And then also that just because they've got all of those factors that you can click the button on, as you said, for different programs, that creates as well some different premiums. When you're looking at those, for people that do still use a hormone, some of a growth factor hormone for their calves, do you have any information about whether or not the increased weight counters the premium for a natural program?
Oh, that's a good question. I would say on average, it probably breaks even. I have to.
If it's too speculative, that's just fine too. So
I'm sure there's a nutritionist shaking his head at me right now. I think on average they kind of break even. The big caution, I guess, and I mentioned it earlier, but if you are going to make that transition to not use hormones and stuff like that, to make sure you are just marketing yourself in a way that can capture that advantage. Along those same lines, one of the things I really like to highlight when I talk to people is I talk to so many producers that are spending a lot of money on improving their genetics. And I showed earlier that producers who spend more on their bulls do capture more value when they sell them. But to make sure that they are taking advantage of that, if a producer is spending a lot of money to improve their genetics, but they're continuing to sell on a per pound basis at the sale barn, they might not be best able to capture that value. Or if they are selling through a sale barn, make sure that that announcer or that ring steward is mentioning those to the audience. I talked to a professor at Oklahoma State who was doing an analysis of those sale barns, and he mentioned that there was numerous times where there'd be a couple loads of cattle run through the arena, and they'd say, "Oh, I forgot to mention that these are so-and-so genetics, or these went through this vaccination program." And it's on the producer to ensure that that information is being put out there, because those add up quite a bit.
I'm going to mess this up, Matt, but I read something one time about marketing, and it was something along the lines of, without telling people what you're doing, it's like winking at somebody in a dark room and expecting them to know that you're flirting.
Yes,
You
exactly.
gotta tell them what you're doing. So I've got a question here. Is there any risk of more packing plants closing now that producers appear to have leverage?
Oh, that is one of those things that keeps some of us up at night. Right now, we don't see any of that, but that is something. Well, the last few years, the packers made a lot of money. Some of them kind of got used to that, And so this past year, we saw when packers had decreased margins, they cut their kill capacity to kind of better suit that. Now, talking to employees at those plants, they prefer to maintain a steady 40-hour work week. But where we've shifted that, we want to be careful that we don't shift leverage too much, that we lose any of that packing capacity. So at this point, there's nothing that says we're going to lose packing capacity, but in fact, we're going to add to it. But again, that is something that we want to, if we do foresee happening, we want to be aware of and kind of jump on it. But right now, there's no indicators. But yeah, it is a worry in the back of everyone's mind.
Next question is under the scope of if you're going to resell an animal within a year, which has a higher projected return, a heifer calf or a bred cow?
Ooh, that's a great question. I'd have to do the math on that. If whoever asked that could email me that question, just so I can know to respond to you. That is a great thought, and actually that would make a really good little case study for us to use here, and maybe another article for me. I don't know the answer off the top of my head. One of our other guys, Troy Appelhans, who works heavily in that market, might know that answer a little bit better than I do off the top of his head, but I'd have to put pen to paper to figure that out. So really good question. Please email me that so I can be sure to get back to you on that, but I don't know.
Perfect. We will connect the two of you. And then do you have any concerns of decreasing exports to the Asian markets affecting domestic prices?
It is a factor that plays into our wholesale and retail demand indexes. And so it will play a little bit of a role in prices. Keep in mind, a lot of what we export is the higher quality or the middle meats. So those tenderloins, ribeyes, strips. And so as we do lose a little bit of that demand, we lose that export market. That does hurt our prices a little bit. That being said, we're at a point in our cycle where we're not going to have a ton of excess supplies anyways. And so that does counter it a little bit, but it is a net negative impact on the overall price. Yes.
All right. Well, if anybody else has a question, we've got time for one or two more. I'm going to throw out there that, you had said that we haven't hit our low yet for the U.S.
Correct.
Cattle herd. We're still looking at that. Of course, typical supply and demand. It's when we have the low, that's when we should have our high for our prices. What will the indicators be when we've hit that low? How can people make sure that they're watching and realizing that that's happening without missing that window? And I'm thinking that for us regionally, we'll see the rainfall. We'll kind of feel that people are going to start buying, but of course that's too small of a scope.
Yeah, that'll display itself more in like the global price trends for those calves. It's one of those things where, again, there's that couple year difference between when you make the decision to keep and breed a female versus when you have a calf out of her that you can sell. And so a lot of it is, just as we kind of watch those cattle on feed supplies, and we particularly pay attention to those like heifer rates within that feeding group, within that overall herd. That's what we kind of use to kind of say, okay, we're starting to see expansion taking place. That means within another year, we'll hit the supply lows and start to turn around. Again, we saw attempts at that this past year, but it didn't work out. This year, weather's not supportive of it right now. I mean, those increasing prices, the market is telling us to expand. We just are limited by weather. And so, yeah, for us, we'll look heavily at that heifer as a percentage of fed slaughter ratio.
Thank you to Matthew McQuagge, again, analyst with CattleFax, for joining us for this first Rural Resilience webinar of 2024. And as we get going through this, we do have 3 more webinars that are coming up this year. You can read those there on your screen, but we're going to be talking goats. We're going to be talking about community resilience, and then also direct beef marketing, but not your direct beef marketing when there's a processing plant just down the street. That's still coming up here this spring, and we'd love for you to register. Just head to our website, ranchstewards.org. You can get registered right there. It's all free of charge. And hey, while you're around your computer or your smart device, go ahead and click subscribe on our YouTube channel. We'd really appreciate it. Until next time, thank you for being part of our Ranchers Stewardship Alliance community.